Good morning, sir. Hi, Anand. Good morning. My screen is visible. Just write in the chat box. Cool. So today we are going to discuss about the corporate banking facilities and other financing forms. And as we know that corporate banking is a vast topic. It includes a lot of things, multiple things which are included here, which we are going to discuss. Probably we will try to cover a maximum topics which are there in the corporate finance, right? And we'll start about wholesale banking. So any idea about wholesale banking? What is wholesale banking? Shreya, let us start because anyhow it is getting recorded and the video will be uploaded because we have to cover both the sessions in these 2 hours. So, so really, it will not be possible, to wait. But anyway, let them join. Let them join, and they will anyhow get the video. Okay. So wholesale banking refers to banking services sold to large clients. So there are HNI bankings, there are corporate customers, corporate clients, corporate accounts. So everything comes under wholesale banking. That can be government agencies, large corporations, real estate developers, manufacturers. Okay. So for an example, for Axis Bank, probably Aditya Birla Group is definitely, it will come under wholesale banking. All right. In the opposite, retail banking focuses on individual clients. Yeah. So yeah, builders are also that. Retail banking will focus on individual clients and small businesses. Like for an example, we open savings account, we get credit cards, personal loans. These are the things which comes under retail banking. Okay. Now, wholesale banking includes also currency conversion like forex services, not for the individual, the currency conversion, especially in terms of LC, working capital finances, large trade transactions, merger and acquisition, consulting and underwriting, among others. So there are a lot of merger and acquisition funding which takes place in wholesale banking. Right? So these are a few products of wholesale banking which we will discuss one by one. First one is asset management. Next is working capital finance, merger and acquisition finance, forex loan, loan participation, merchant banking, and loan syndication. So these are the topics which we are going to cover today. Anand, you are writing wholesale profit less, more prone to cyclical problems. See, actually what happens, Anand, there is a concept like, say, wholesale clients are basically big clients. And when it comes to loans, definitely your rate of interest, your net interest income and net interest margin are quite less, which you get from wholesale banking. Just a moment, guys. Just a moment. Give me a minute. So the major problem is if a single account goes, it takes away a major chunk of business. So for an example, if so bank is avoiding this segment, particularly in lending. Why? Because that is what I'm going to tell you. Say you have a portfolio of say 500 CR in loans, and one particular customer is having 100 CR of POS. Now, if that customer defaults, then what happens? What happens if that customer default? Then the entire profit, whatever you get from 500 crores, your entire NII NIM is gone for a toss. Similar thing for a corporate account, for example, like what do? You in savings account, current account, what do we take? You take money from the customers which you invest. Now, for an example, you have thousands of customers with a deposit size of say around lakhs of rupees. So 1 lakh into 1,000. 1 lakh into 1,000 is 10 CR for an example. Whereas you have 10 customer with 1 CR, right? Now, if two customer goes off, then you have to pay him back how much? You have to pay him back 2 CR, which is equivalent to almost 200 customers, right? So that is how the thing operates. Like it's a major chunk of the business. So what happens? There is something called spreading the risk. So even the companies are right now looking for spreading the risk mainly to the retail customers and the small customers. Next one is merger and acquisition finance. So whenever there is a merger or any acquisition happens, so one company is acquiring another company, then some merger and acquisition finance, some kind of finance is needed. And banks work as a consultant. They put a consultant who will take care of the entire transaction as well as the fund is to them. Forex loan is also something which is foreign exchange loan. So earlier, if you lose something or even if you have purchased Forex, you could get some loan. I don't know currently whether loan on foreign exchange is happening or not, but earlier it used to happen. Then it is loan participation, merchant banking, and loan syndication. Loan syndication is very common for all the big groups. A number of lenders, they come together, they form a syndicate, and there is a lead banker who takes the lead, and then they go for a financing. So what happens? Suppose a customer needs 100 CR. Now for a single bank, it is not possible to give 100 CR to a customer. So what happens? Say around 5 bankers, they come together. One who is contributing major portion of the funding is known as syndicate bank. Say for an example, SBI is saying that fair enough, out of 100 CR, I will be giving 40 CR. And rest 60 CR will be divided among 4 other bankers. So 15 into 4, like that. So in that case, SBI is lead banker, right? So this is the concept of loan syndication. So when we talk about asset management, the practice of increasing total wealth over time by acquiring, maintaining, and trading investment that have potential to grow. Now, asset managers, what they do, I put my money in mutual fund. I don't know where the money is going. I know that probably my fund will be allocated in a ratio of 60-40 or 70-30, depending on my risk-taking ability, my risk propensity. That 70% of my fund will go to equity market and balance 30% will go to the debt market, which will give me a fixed rate of return. Now, out of this 70%, again, there is large cap, mid cap, and small cap. Like whether what is the percentage that will be invested to the large cap or the blue chip companies, and might be because I need good amount of return. So a percentage could be, invested in penny stocks, which can give me immediate good return. So then there also the bifurcation depends on one, my risk propensity that I do not know. I only say that yes, fair enough. Mostly mid, you invest most of the amount in large cap. I don't want to take much risk. Now, when I mention large cap, there could be multiple scripts under large cap. So it is the asset manager, it is the wealth manager. They decide where to invest and they decide when to come out from a particular script and invest that money in other script. And they basically maintain our money. So they are the asset managers or the fund managers. This is the overall process of asset management services. What does that do? One is portfolio management, real estate planning, mortgage planning, asset protection, tax management, and other financial services. So what they do, first of all, they manage our portfolio, equity, debt, it could be some other kind of bonds, right? They manage the entire portfolio with a certain percentage of ratio. When they were there is some turbulence in the equity market and there is a fall in the equity market, probably they suggest us to come out of, sell a portion of their scripts, sell the portion of our shares, and then again invest in, might be real estate, stocks, might be in some mortgage, something like that. They do the entire sets of activity. Apart from that, they are also into asset protection, like it could be insurance, it could be something else, and other financial services. Yeah, hi Venkatesh. This is a typical asset management process where the clients, asset managers are acting as a liaison between clients who are at the at both the ends. At one end, client is giving money. On another end, client is taking money. So what happens? That asset manager comes up with multiple bonds, multiple schemes that you can invest in this. And then again, the same asset manager arranges money for the clients who needs the money. This is the overall, process. So what happens? The process is asset managers take money, they invest the money somewhere, and they give a return to the original clients again with a fee. Now there is something called in equity market, something which is called brokerage. So it could be 0.5% or something 5 paisa, 3 paisa, 2 paisa kind of thing. That is the fee they charge, for giving. But that fee doesn't assure that there will be a profit always. It doesn't assure that. But because of the transaction, every transaction has got certain fees. Right. Now, what are the advantages of asset management? One is improve asset performance, because when there is a qualified and skilled asset manager is funding you, is managing your fund, then obviously there is an improved asset performance. So because everyone might not be financially that much, strong, or everyone might not be having adequate time to, look at the terminal always, that whether share price is going up or coming down. And so what happens is somebody has to be there who should be vigilant and taking care of your fund, whether it is growing or whether there is a threat, any threat for that. So that's why your asset performance increases. It helps in business growth. So what happens if this is your business, your overall asset is being maintained properly, then obviously it helps in business growth in terms of top line and bottom line. Next is effectively manage risk, because they know which share is going, which kind of instrument is not giving the desired return. So obviously we need to come out of that instrument and then we have to invest it in somewhere else. So this kind of thing is basically, you can say, manage risk. When it comes about forex trading, we talk about hedging just to avoid currency fluctuation. So this kind of management of risk efficiently is done by the asset managers. Obviously, when they do so many things, your asset value gets improved. Reliable decision making, because but whom do we trust? So we put our money in SIP or the mutual fund, trusting on the fund managers because they are qualified enough, either they are CFAs or they are CAs and they are into the market, they know the market much, much better than us. So their decision would be much more reliable. Another is, once all these things are done properly, stakeholder confidence is an important thing. So what happens? Even suppose your treasury manager is managing the treasury functions and the idle funds of your company properly, then what happens? Automatically your fund grows, your overall your overall profit is increased, and naturally all the stakeholders in the company, they get a confidence on the asset manager and asset management process as a whole. Okay. Any query till now? Any query for me or any inputs before I go to the next session, next one? Okay. Has Praveen joined today? I can't see Praveen. No, I guess he has not joined. Praveen has joined. Well, this is very important topic where we are going to discuss about working capital finance and what are the different types of working capital. How it is significant for a business growth. Now, there are, so first of all, like before I go to working capital, I'll just simply open Excel and we'll talk basic things. Just we'll have a chit chat about what is working capital. So what is working capital? What is working capital? So what is working capital? Can you write in the chat box? What is working capital? Can you guys please write in the chat box? Buying raw material money spent to convert to FGF. Fund requirement to run a business. Very good. So it's a fund required to maintain a daily operational activity of a business. That is what happen in a year means. Anand, I didn't get your point. I'm not getting your point. So basically what happens, why do you need to have your fund? Because working capital is nothing, but it is current assets minus current liability, right? This is what is working capital. Now we know what are the current assets. It could be debtors, inventories. It will happen in that year PL. I don't understand, Anand, exactly what you want to say. No, basically working capital figures comes from your balance sheet. What is the difference between the current asset and current liability, right? So basically your debtor, inventory, cash and cash equivalent. The major portion of your current assets. Current liability is basically your creditors and bank overdraft, right? So once there is a difference between these two, say this is 100, 200, 250, comes to 550. This is 100, 100. This comes to 200. So your working capital is this minus this, right? So we will discuss about how do we calculate working capital limit. So normally there are multiple forms of working capital finance. One is overdraft. So what is overdraft? So for an example, I know that if my bank balance is say around if my bank is having a balance of say around 50,000, I cannot withdraw anything more than that. But if the bank says that based on your transactions, I am giving you a 5 lakh overdraft. That means I can withdraw up to 5 lakhs, which I can use in my business, right? Which I can use in my business, right? Another thing is cash credit. Cash credit and bank overdraft is to some extent similar. Cash credit is again giving a limit of say, it could be around 10 lakhs, 5 lakhs, it could be up to 10 CR, 50 CR, depending on the stature of the business. The second thing is buyer's credit. What is buyer's credit? Anybody, any idea? What is buyer's credit? Any idea about buyer's credit? You can write in the chat box. Any idea about buyer's credit? Well, it could be import credit. It could be normal buyer's credit. So normal buyer's credit is nothing that I want to buy something and somebody is giving credit to me. They will pay to the seller on my behalf, and the seller will deliver the goods to me, and I will have to pay the financer. Simple concept is that buyer's credit. It is not seller credit. So it is funding the buyer, not the seller. Next is bank guarantee. Now tell me, what is bank guarantee? Bank guarantee is a non-fund based limit. What is bank guarantee? It is not a fund based limit actually. Any idea about bank guarantee, how bank guarantee takes place? So Tanuma, it is not only in export-import transaction. I must tell you that suppose you are a vendor, especially a PSU vendor. PSU vendor means you want to, you have taken a contract from PSU. It could be PSU bank, it could be PSU like an NHAI, right? So they, what they do, they take a bank guarantee to be given by a bank on behalf of the customer, that the customer will fulfill all the committed work, and in case they fail to fulfill the committed work and they leave in between, then we will compensate the contract issuer. So bank assures that we will make payment. Again, this is a non-fund based contract. This is a non-fund based contract, and it happens only subject to a condition happening, only on happening of an event. What is that event? The event is default by the party. So bank guarantee is a promise to pay to the issuer of the contract only in case of happening of an event. That event is default by the party to complete the work in the within the deadline. So this is basically a bank guarantee, and as on date, even if you want to take a bank guarantee, then also you need. So bank will recover the money from the party. What happens? They do take a collateral to issue a bank guarantee. Collateral could be in the form of FD or anything like FD, mainly FD they do take, or even in some other assets, mainly they do take FD. So for an example, if I need to give a bank guarantee of 50 lakhs, I have to deposit, I have to make an FD or create a lien on an FD equivalent to the bank guarantee amount, or at least 80 to 90% of the bank guarantee amount. And then only they will give a guarantee that in case, I have to pay the money back to the contract issuer, that I can liquidate the FD and I can get the money back. That's it. So this is how bank guarantee happens. Packing credit is basically, normally it is given to the exporter and importer. It is again on goods that is being sold or bought, is a credit is given mainly to the exporter and importer. And bill discounting is getting the bills discounted. So for an example, I am a vendor of say Airtel, right? So I have raised a bill of 5 lakhs. Now I need money. I don't know when Airtel will pay me money. Airtel might pay me money around after 60 days. But I have to keep my business running. Since I have to keep my business running, I need the money. What do? I get a sales invoice discounting. Sales invoice discounting, and I get 5 minus X lakhs immediately, right? Now the next question ideally should be, what is this X? Now this X is the discounting amount discounted. Normally it could be 2%, 3%. So if there is 3% discounting, means 15,000 will get deducted from 5 lakhs and the balance 4,85,000 will be given to the party. Because like you don't need to wait. But there is a catch here. What is the catch? The catch is, once again, the catch is the bills has to be submitted, or the principal company has to be A category or B category companies based on the credit policy. Like for an example, if the bills are submitted to companies like Airtel, Tata Steel, okay, Birla, say Reliance, fair enough, good companies, A category companies, so bill discounting can be given. But if for an example, if I sell materials to XYZ company, who is a local company in my area, and then I want to get the bills discounted, the bills might get discounted, but definitely I have to give equivalent amount of collateral for that. So this is one part of bill discounting, that is sales invoice discounting. So there is something else also which is called purchase invoice discounting. Purchase invoice discounting. What is purchase invoice discounting now? Now, can anybody? Durga, it's a good question. So every bank has a list of the companies for whom they will do bill discounting. Honestly speaking, I don't think that SMEs, even they are listed, their bills will be discounted without any collateral. I don't think so. But again, if anybody is already into the PSUs are very aggressive in this. Even private banks are also. So they can give a, they can throw some better light on this. Okay. Well, now the next portion of bill discounting is purchase invoice discounting. Now, I have given you a concept on sales invoice discounting. Can anybody here throw some light on purchase invoice discounting? If not, then I can definitely I'll explain. I'll anyhow explain. Any idea about what is purchase invoice discounting? Okay. So purchase invoice discounting is basically the way sales, correct, buyer uses the bank. So I have raised a bill. So somebody has raised the bill against me. So might be, say for an example, XYZ company. I have purchased something to XYZ company and he has raised a bill of say 30 lakhs. I approach bank that I need my money. If I pay 30 lakhs immediately to this party, then obviously I'll be running short of working capital. I need working capital to run my business. So what do? What I can do is that I can submit all these bills, prove that I have got the goods delivered, and then I can get the amount, obviously lesser net of the discounting, right? So again, they will probably pay me INR 30 minus X lakhs. That's it. So this is what is the concept of purchase invoice discount, right? So there are certain approaches to working capital finance. Especially there are some advantage and disadvantages of working capital finance. The major advantage is low financing cost and high profitability, lower carrying and handling cost, highly efficient working capital management. Now, see, normally in CCOD, probably you get something around 11%, 10%, even at 9% some banks to offer, based on the credential also. And naturally, once your finance cost comes down, you have high profit, high margin from the business, right? So what happens is, second thing is lower carrying and handling costs. So obviously, like once you are getting a working capital, you have fund in your hand and you can always negotiate, and with the transporters you can negotiate with even your suppliers. And obviously it leads to highly efficient working capital management because you have fund. What are the disadvantages? The major disadvantage is insolvency risk. Now, why insolvency risk? Because what are the items on which you are funding? What are the items? Tell me one thing. What are the items on which you are funding when you are going for working capital? Say for an example, CC or even OD. So what are the collateral here? What are the primary collateral here? Debtors and stocks, right? So now at any point of time, if debtor doesn't pay back money, so that's a loss. Second thing is, assuming the stock is not perishable, in that case also, the stocks can get damaged. That stocks can be, manipulated. The stocks can be sold and the money is not returned to the banker. And the stocks can be sold and the party is not able to recover money from his debtors. So all these things will lead to something called insolvency risk. Or the party has become insolvent. Party overall has become insolvent, that I have become insolvent, I'll not be able to pay your money back. Right? Second is lost opportunities and unexpected shocks. So there could be unexpected shocks like COVID. There could be unexpected shocks like demonetization. Okay, that I'm not able to. Or there could be unexpected shocks like obsolescence, like something which is there and immediately something new has come out which has substituted this one. For an example, I got an iPhone 13, I think in August or September. And just 2 days after that, I have seen in paper that iPhone 14 was launched. The moment iPhone 14 was launched, people obviously will crave for iPhone 14, not for iPhone 13. Now, imagine you have funded a trader who has 90% of his stock, 90% of his stock is iPhone 13. Now nobody will come and ask for iPhone 13. Everybody is asking for iPhone 14. So this is another shock, right? Mergers and acquisitions, it's a general term that describes the consolidation of companies or assets through various types of financial transactions, including mergers, acquisitions, consolidations, tender offers, purchase of assets, and management acquisition. So we know mergers also happens, acquisition also happens. So any significant acquisition or merger examples you can give in the chat box, please. Whatever you know. UBS Credit Suisse. Yes. Praveen, I was looking for you. LTIM. What is that? What is LTIM? Tech Mahindra. Okay. LTIM. Okay. There are a lot, even in financial sector also, like HDFC took over Centurion Bank of Punjab. Magma is being taken over by Poonawalla. Magma is being acquired by Poonawalla, say around 15-20 years back. Saatchi was taken by Magma. Yeah, IndusInd Bank, correct. HDFC and HDFC Bank Limited, correct. That's a very recent example. Absolutely, HDFC Limited and HDFC Bank. It's a merger, right? Correct. IDFC and IDFC Bank, Tata Steel Bhushan, right? ICICI Bank merger with ICICI Securities, correct. Right. Merger and acquisition strategy. So these are the strategies and overall process, like hunting of the target company and study of the business of the company to be purchased. So naturally, one is you you look for a company. So probably there are two ways of doing business. One is you set up a business, you scale it up. Now that is a time consuming factor, and all the promoters, they might not be having that kind of patience that no, it will take 3 to 4 years to scale up to a particular level. Second thing is acquiring a company which has already spread its wings and already operational with their full-fledged team, right? So just a second. So then whatever company you choose to acquire, what you are going to do first is you have to study the entire company financials and the sector as a whole. Study of market should be undertaken. So obviously you will, once you study the sector, you have to correct. Correct. So when we talk about merger and acquisition, then obviously we talk about inorganic growth. And obviously, if you purchase an already running business, you get their assets, you get their liabilities also, along with their entire full-fledged tasks, right? Full-fledged task, everything, right? Then you study the market, understand, you take consent of both the companies for mergers and acquisitions, and then approval of all the stakeholders and shareholders for the mergers and acquisitions. Okay. It's a 5-stage of merger and acquisition process where corporate strategy is evaluated, that whether to go ahead for merger or acquisition or not. In organizing an acquisition, so if it is an acquisition exclusively, then organizing the acquisition, and then deal structuring, like there are a lot of things like equity swaps and all these things, and then post-acquisition integration and post-acquisition audit. So one is post-acquisition, you have to integrate all the departments. So one finance department from company A has to be integrated with finance department of company B. Similar thing for marketing, HR, for the core activity departments. And obviously, after the entire acquisition is done, there is a post-acquisition audit, which says that entire process, which has moved seamlessly, was perfect or not. How do you finance acquisition? There are cash transactions that probably they will not go to the financiers. It could be stock swaps, it could be debt financing, it could be mezzanine debt or quasi debt. So for the time being, a portion of the debt is only a portion of the activity is funding, a small portion, or could be, up till the deal happens, there is requirement of some amount of money which is being financed. There could be equity investment, there could be vendor take back loan and leveraged buyout. Right? These are different modes of financing. This is what is called as foreign currency loan. So when we talk about foreign currency loan, it is basically replacement of term loans by foreign currency term loans, and can be dispersed in 4 currencies: US dollar, sterling, euro, Japanese yen, with a maturity period of 6 to 7 months. It can be repaid by bullet payment, or in stipulated installment, or by conversion of rupee term loans as per the terms of original sanction. This is a process of loan participation where a single borrower approaches one particular bank, and that particular bank coordinates with 4 other banks to get the entire amount. Merchant banking has 2 different activities. One is banking service. It helps businessmen to start a business and helps raise, collect, finance. And consultancy services, like it could be financial, marketing, managerial, and legal matters. This is a loan syndication. As we had discussed that probably there is a requirement of a party which is a huge amount and cannot be funded by only one particular financer. In that scenario, what happens? N number of financiers, they come together and they decide that what is the amount they each can contribute, and whoever is the largest contributor in the deal is the lead financer. This is a typical structure of loan syndication. So ABC company needs a loan, who comes to the primary loan market, then the primary loan market, from the primary loan market, chosen banks are 1 to 6 initial syndicate members, and they are again further, they can take money from the multiple bankers who are the further syndicate members. So they are secondary market. One is primary loan market and the secondary loan market, and everyone makes a syndicate and contributes to the borrower. Underwriting syndicate constitutes of several investment banks and commercial banks that have formed group to sell new securities. These are temporary in nature. Structure of the underwriting syndicate is similar to a pyramid. Our lead underwriter along with few co-lead managers having entire responsibility for smooth execution and completion of the entire IPO process. Then banks and co-managers are at intermediate and bottom levels who work according to the responsibilities allocated to them in the agreement. So one is a lead underwriter, another is the bank managers. The avoidance is just to avoid risk for the issuer. Second thing is seamless flow of information. Third thing is sharing of risk and responsibilities, flexibility in size of an underwriting syndicate. So one is, why do the major importance of syndicate underwriting or syndicate loan is when too many banks are involved, then the due diligence become faster and due diligence become much more proper, because everybody has their own network and area where they are operating. So what happens? The information flow becomes seamless, uncertainty is reduced, and also because everybody is having stake in the loan, then obviously that entire risk doesn't go to one particular financer and it is being shared. Also flexibility in size of an underwriting syndicate. Okay, so this was the first PPT for today. just from 11:30, we'll start for the second PPT. Is it okay, guys? Or any question, any query for me? Okay, anybody else? Yeah, merger and acquisition, especially acquisition is not smooth at times because the company who is acquiring, for them it's fine, but the company that is getting acquired, there are a lot of resistances internally. And actually a hostile acquisition happens, and that is also not good. Always what happens is that one sec, guys. So always what happens, it has been seen that always it has been seen, it has been observed that once a company takes over, then obviously the moment they take over, the first thing they do is they ask the existing employees to leave. Obviously, after a certain point of time, the moment they understand entire process and system from the existing employee, they create a situation so that the existing employees leaves. That is a trend which has been observed for the years. Okay. Anything else, guys? Anything else? Okay, let's start at 10:30. Okay, we'll start at 10:30. Thanks. Hey, hi guys. Can we start or should we wait for 5 more people to join? Should we wait for 5 more minutes? Or should we start? Hello. Hi everyone. Okay, let me start. Can you please write in the chat box, should we start or should we wait for 5 more minutes? Okay, Manish. Yeah, Manish, please ask. Please ask. Manish, you are free to ask. So I missed, there are a lot of discussion happened, right? In CCRA, there is 2 levels. So can I give exam individually? See, credit research experience also, CCRA, you can say it also is an entry pass for credit research. So may I know exactly what is your domain? Manish, may I know exactly what is your domain? Okay. So that's a good thing. So since you are into data research analyst, then obviously you are working on Python, right? Python, R, all these things. Are you into predictive modeling? So what do you do in data research? Are you into predictive modeling? Financial data. Okay. So obviously CCRA course will give you an edge and you can get into credit risk modeling with your skill set of data analysis. You can get into credit risk modeling, which is actually a much talked about term now, and it is the future. So normal credit underwriting is going to go. It will not exist because everything will happen in an automated manner. Okay, guys, let's start. My screen is visible. Okay. So there is some other parts which we are going to cover in this session. One is letter of credit. So uh, a letter of credit, as we know, it is also, again, it's a guarantee of a bank to another bank, especially takes place during export and import transactions. So what happens normally? So let me show you this way. This might try. One sec, guys. Yeah, Durga, I'll come to this. Letter of comfort is less binding. Letter of comfort doesn't give an obligation to the issuer, but letter of credit gives an obligation to issuer. It is to some extent similar to, you can say, bank guarantee, where the banks takes the responsibility. Now, why and how I'm going to explain it to you. Now, this is a country A. Okay. This is country B. This is company A. Yeah, it's a very good free software actually. Company A. And better you use mouse. It is better. Always use mouse. Even if you are working on laptop. Right? Now, company A, say from this is a country, India. This is a country, Japan. Now, there is a deal which took place between these two countries, country A and company A in country India and company B in country Japan. Now, how does financial transaction take place? The financial transaction will take place between the banks, right? Say one particular bank is here, and again, one particular bank is here, right? This will happen. Yes or no? So this is bank one. And this is bank two, right? Now company A is saying that you give me goods. Company B is saying that how do I deliver goods? I don't know you. What is the guarantee that you will pay money? Now company A says that fair enough, even if I pay money in advance, what is the guarantee that you will deliver goods? Number one. Number two, what is the guarantee that you will deliver the goods committed as per your committed numbers and quality? What is the guarantee? Both are right in their space, right? Now, what is the solution? There has to be someone who is working as an intermediary. Plus, purchasing involves a cost. Now, what happens? Company A is the seller, company B is the buyer, or rather, company A is the exporter and company B is the importer. So, company B is saying fair enough, because I am purchasing from you, my bank will issue a letter of credit to your bank that yes, I am taking the guarantee of company B that company B will make payment within this many number of days. And I am giving the money to you the moment you deliver goods. So the shipping takes place from here to here. The shipping takes place from here to here. Right? The moment the shipping takes place, the goods are arrived, I will take few documents and then immediately I will remit the payment to you. Right? I will check the goods and remit the payment to you. Not you, to your bank, bank one. Right? Now, this kind of promise is called letter of credit or LC. Clear? It's a slightly complicated process. Clear? Yes or no? Yes or no? Yeah, documents get exchanged from bank to bank, right? Right? This is actually a flow of overall activities and transactions happening. Now, bank 2 has given money to bank A, where from bank B, bank 2 will recover money. Bank 2 will recover money from company B. Bank 2 will recover money from company B. Next is, there is a concept called usance period. Has anybody heard about this usance period? What is this? So 30 days, it could be more than that, depending. It's a credit, correct. Usance period is credit. So bank 2 might be given, or in this deal, there is an usance period of 60 days, for an example. So even once goods are, loaded goods are delivered, as per the deal, probably bank 2 is supposed to make payment to bank A after 60 days of the landing of those goods in for company B in country 2's port, right? So 60 days is the usance period. After 60 days, bank 2 will make payment to bank 1, and then whatever be the deal with the company B and bank 2, company B will pay that money bank to bank 2. This is the overall concept of LC, right? This is a process of LC. Buyer is unable to pay and buyer's bank issues LC for on time payment. This is the overall LC process. Yes, so there is a risk for which currently this banks, the bank you accept, the LC of a bank which you accept is normally national, not nationalized bank, or better, it's a multinational bank. So normally if you see the transaction takes place normally through the banks like Stancy, or HSBC, so which has presence in multi countries, There are many companies or the banks who don't even accept the LC issued by only country specific bank or a local bank. They don't accept. Especially there are some countries for which other than global bank, LC is not even accepted. Say for example, Pakistan, Bangladesh. So even if they say that this is a State Bank of Bangladesh or something like that, or a Nationalized Bank of Bangladesh, normally LC is not accepted unless it is coming from a global bank like Stancy, HSBC, or something like that. Okay, just 2 minutes, guys. Just 2 minutes. Yeah, guys, sorry. These are different types of LC. Just I'll go through it. Commercial LC, a standard LC, also known as documentary credit. One is export-import LC. Okay, there are inland LC also, like it's not that always export-import. When we talk about export-import LC, the LC depending on who uses it, if it is used by exporter, he will name it as exporter LC, or if it is used by importer, it will be named as importer LC. Right. Another is transferable LC. So where you consider LC as a kind of asset which is transferred from one to another. So as the name says, it is transferable to the next supplier in the chain that allows the beneficiary to provide its own documents, and the beneficiary is only an intermediary for the actual service supplier. There are untransferable LC also which cannot be transferred. A recoverable LC that can be altered at any time by the issuing bank, like terms and conditions, what are mentioned are not irrevocable. Those are revocable LC. So that can be at any point of time if the bank wishes, they can alter the terms and conditions which is being mentioned in the original LC. Irrevocable LC is exactly opposite to revocable LC. That is, the terms and conditions cannot be changed at any point of time. When I say standby LC, it ensures the payment to seller if anything wrong happens. So what happens? That something wrong happens, immediately the seller has to be compensated. Confirmed LC, when the advising bank also guarantees the payment to the beneficiary, it is called confirmed LC. Yeah. Unconfirmed LC, this is assured only by issuing bank and not in need of second bank. A revolving LC, this can be used for many payments instead of issuing for each of them. Back-to-back LC is two LCs. One LC is supporting the other LC. Red clause LC, 1 second guys, this is hiding. So red clause LC is the partial payment before the goods are shipped, like an advance against the written confirmation. So even, so suppose there is a deal of $5,000 where a portion of the payment is done. And green clause LC are same like red clause LC, but the only difference is proof of warehousing is given to the seller. So the proof of warehousing is given where advance payment is done. There are few advantages and disadvantages of LC. The advantages is safely expand business internationally. So if I am an exporter or I want to sell my products to a foreign country, LC is the only way by which I'll be able to do my business. All right. Highly customizable. It is highly customizable. That means as we have discussed, there are many forms or different types of LC. So based on your business requirement and my capacity, I can customize the LC. Second thing is seller receives money on fulfilling terms. So seller only receives money when he fulfills the terms. There is no chance of seller being running away with your money and your goods is not delivered as per committed quantity or quality. Now, works as a credit certificate for the buyer, obviously, because the buyer who is ready to spend money to buy something, LC works as a credit certificate for the buyer. right? Seller is free of credit risk. Payment assured in disputable transactions. So even first of all, there is a minimum chance of disputes in the transactions. And even in dispute, even if dispute arises, because banks are involved and those banks have their own level of image, brand image, so they definitely take care of that. Timely payments leads to better cash flow planning. So it's not that you are supplying goods to somebody where there is any problem in payment, and because that cash flow is affecting the cash flow of your overall business. Pre-shipment financing is available to the seller. Also before shipment, also there are some LCs where conditions says that pre-shipment credit is given. Like, I am manufacturing the goods exclusively for company B. For an example, Anand is in Texas. I am in India. Anand has given me some orders and I am exclusively, see, I have to procure raw materials and start manufacturing those, right? So what I have to do, I have to ensure that I have to get some money in advance so that I can start procuring. And that's also a kind of assurance that Anand cannot turn back, that once I have manufactured all these goods, he cannot say that I don't need. So it's a kind of raw material financing, which we call as pre-shipment financing also. Now, what are the disadvantages? Disadvantages includes LC comes at a fee. So we have to pay a certain amount of fee to get an LC. Some partial shipment is to be allowed. Yeah, LC expiration date is a big issue. That's true. But then that is definitely an issue. At times it happens that by the time I manufacture, I do shipment, LC is expired. That happens. But I think the date can be extended also. If not, it is executed, the date can be extended, right? Because it is not executed, right? Yeah, so whoever has issued LC, if they request back, since it has not been executed, so it can be extended also. Because I remember a long time back, I had done a deal of LC, which is importing of a foreign machinery from China. No, he can cancel deal means you are talking from bank or the buyer. No, buyer can cancel deal, but now for an example, you need that item. So again, it is on demand supply. You are not getting it from anywhere, but that is the only producer or manufacturer we supply. No, you will threaten is something different. That totally depends on the situation. So buyer needs it. Buyer will not get into confrontation. He will accommodate, certain things. He will accommodate and probably see when you get into a business transaction, everybody is aware about their situation and matured. So why somebody will threaten somebody? They will not threaten, but obviously he needs the machine within a timeline. And definitely, if it doesn't happen, then there is a breach of commitment kind of thing. Again, there could be some genuine issue for which the seller could not deliver or could not do the shipment. So in that case, buyer, if he is considerate, there is a scope to enhance the LC. Might be the bank can charge some fees, but that there is a scope. Okay. So one major disadvantage is it is having a bank fee. Second is time consuming formalities, because any kind of LC opening is obviously a time consuming factor. Reason is normally if I do not have that much amount of transaction, the bank might ask for a collateral for an LC, and that collateral comes in the form of cash equivalent, that is FD. Next is fraud risk. The biggest example is Nirav Modi. right? Biggest example is Nirav Modi, fraud risk. Any other fraud risk? Any other fraud, recent fraud you have seen? Nirav Modi is the one. Other than that, she has misused PNB's LC. Right? Next is currency risk. So currency risk is yes bank, right. Yes bank, correct. Same party invoicing, true. Well, a situation can arise, right? I have formed a company in another country. Probably the directors are different, but basically it is my company only. And I'm doing an LC transaction from India. Does it happen? It can happen, right? Over invoicing, correct. So normally over invoicing doesn't happen. In LC cases, especially for certain items, which is the heavy machineries, under invoicing happens. So under invoicing was specially happening. So if I talk about construction equipments, mainly the heavy capacity cranes, if you have seen, like there are a lot of cranes which are quite heavy capacity cranes, which are imported, and those are refurbished cranes. Like used cranes which are refurbished, and those are imported from the countries like Europe, America, and from those countries they are being refurbished. Under invoicing happens just to avoid the custom duty, because a certain percentage of custom duty is levied on your invoice price. So if that is under invoice, then custom duty is reduced. Yeah, second-hand bikes like Harley also, true. Okay. Currency risk is basically nothing but change of currency values for foreign exchange fluctuation. The mitigate can be hedging. Another, it's a time-bound process, ideally as per the conditions of LC, the shipment has to be done within this time and the material of goods has to be reached in this time. And until and unless that happens, the process cannot be executed. Yeah, documents take some time, and LC resulting in demurrages, I understand. That sometimes happens. Next is risk of default by issuing bank. So what is this? A risk of default by issuing bank is, that is what I have shown you in the draw IO, that when bank 2 is promising to pay bank 1, if bank 2 defaults, what happens if bank 2 defaults? That is the reason for which the best way to mitigate is that both the banks has to be good banks, and they have to have their global presence. Like currently, more acceptable LC is from global banks, because they have their presence in multiple countries and their brand image is much more strong compared to the local banks. This is a supply chain finance process. Buyer A supplies good. Buyer is A and supplier is B. Now, this is how supply chain finance operates. One is A buys goods from the B and the amount is paid by financer. So what happens? The first step is A buys goods worth $1,000 and supplier B invoices goods worth $1,000 has been raised. Then what happens? Buyer A approaches the financiers along with the invoices. So buyer A has got invoice from supplier B, and buyer A has given all these invoices to financer. Financer transfer payment directly to supplier B, not to buyer A. And then financer approaches buyer A for the payment. This is the overall supply chain finance ecosystem. Inventory financing, a short-term loan or a revolving line of credit that a company uses to purchase inventory. So we all know, anybody who is working in finance, NBFC or bank, there's a department called supply chain finance or inventory financing. Is there anybody who is working in lending space? Might have heard about supply chain finance or inventory financing. Or even in CCOD. Anybody? Anybody who has worked in CCOD, supply chain finance, inventory finance? Okay, Praveen, we monitor credit risk for such business, especially LC and supply chain finance. Praveen, in LC currently, what are the risks which you have seen from your practical experiences? Just if you could throw some light on this, so it will be a good learning for all of us. Just you can write on the chat. Okay, I'll unmute Praveen. 1 second, Praveen. Praveen?
Hello. Yeah.
Yeah, Praveen, please.
Yeah. So our scope is limited to credit risk. There can be other risks associated with that as well. So from credit risk perspective, right, the way we treat letter of credit or supply chain financing is on similar lines to how we treat an ordinary loan, right? The only difference is that when it comes to letter of credit, the only thing what we have seen is credit is not a very big player, so it's not a major portfolio for them. But to the extent I have seen letter of credit is that they always backed by collateral. So there's heavy on collateral.
Sorry, they always backed
by collateral is something.
Yeah, absolutely.
Credit Suisse look forward to while backing.
So normally it is FD.
Cash component, yes. So not only in terms of FD, it doesn't matter from creditor's perspective as long as it is cash equivalent. Yeah, it can be from business point of view. And the second thing is that letter of credit is very separately monitored from the creditor's perspective, especially in this scenario, right, on the global, because generally these are like between exporters. So for example, this Russia-Ukraine crisis, when it had happened, so creditors was used to do this LC with Russia and all, right, where banks were involved. They cancelled all those letter of credit that point of time, and those portfolios were reversed. So this is a major risk, at least I have seen, because the terms and condition of letter of credit is not that simple to revoke from the banking point of view, because it's legally binding agreement. So this is a major risk I have seen more from the geopolitical in the recent time. Okay.
And what is your take about supply chain finance risk when I talk about supply chain finance risk, and especially in terms of inventory fund?
Inventory financing not very close, and supply chain financing is also very limited. So this we have seen that they approach bank for getting any invoice cleared, and bank charge fees on it. But generally these are short term, right? So what happens is the risk from the creditor's point of view, theoretically, it is a lower risk because generally it's not a very big amount of what they look forward to. And second is, it is for a very limited time frame. So from creditor's point of view, it is a less risky business, the supply chain financing, but nevertheless, you still have the risk to do. But they are not very big in supply chain. And inventory financing, I have not seen it.
Okay. So supply chain finance, what kind of collateral normally you take?
So in credit sales, I have seen majority of collateral has always been in cash equivalent in order to reduce your exposure that they consider. So companies also provide a lot of securities, right, as a collateral. But in order to monitor credit risk and in order to consider, generally banks for such kind of things I have seen follows a bit of a conservative approach, right? And they always prefer cash equivalent something in order to go for any lending business. But if they get security, they also agree for that, but generally they do not use it to offset the exposure. They keep it as a collateral, but they do not consider as an exposure offset when it comes to the lending business.
So one more thing is that, what about FLDG?
What's that? Sorry.
A first loan default guarantee. So normally it has been seen by many financiers, like even when I used to work for inventory financing, so we used to take FD equivalent to, even in project financing, FD equivalent to say around 2 months, 3 months interest amount, or even 2 to 3 quarters EMI amount. So in case it is a term loan, then in that case, that is called as FLDG. So that particular FD is kept aside in case there is any default in that. In that case, what happens? The FD is being liquidated and the money is recovered. So do you from Credit Suisse take any FLDG as well?
They might be doing because from business point of view, but from the risk point of view, as long as we have this cash equivalent data into our systems, you will consider that as from the risk perspective.
Okay, but cash equivalent up to what percentage of the exposure?
So
like
it depends.
100,
it depends. So no, it depends. So it's not always. I've not seen at least 100, but it depends, right? Because it depends on the counterparty. It depends upon the lot of risk, right? The rating of the counterparty, because we have seen that unsecured lending is also done, and at the same time, I've also seen that they ask for 100% collateral for any counterparty. So, for example, right now, at least for high risk countries like Turkey and where they are doing business, it's not that they will stop the business, but they consider majority of their exposure to be covered. But when it will come to obviously US or any other countries, it might also come down. So I have seen it depends on two. One is geopolitical, where the exposure lies. The counterparty's country of risk lies. That is important. And the second thing is important, the rating of the counterparty, right? If it is highly rated, very liquid, like for example, to some financial institution or very big corporates, then obviously they are ready for low collateral and very low collateral as well, right? So they keep sizable amount of exposure unsecured with high rated counterparties, but it gets evaluated very frequently. Earlier, that frequency used to be like monthly, quarterly, but now after this geopolitical, what we are seeing, interest rate tightening, these gets how you say evaluated on a very, very regular basis and keeps on changing, right? So like few months back, Turkey was not be maybe a high risk, but now at least the
sorry,
country
just missed something. Can you come again? Just few months back.
So for example, few months back when Turkey lira was doing good, right? So it was considered as a highly considered a good, less risky business if you're doing with Turkey. But after that lira plunge, they suddenly became very, very cautious. So they have removed their exposure, or at least it has to be backed by collateral. Same for Saudi Arabia. So it used to be considered as an oil-rich country, but with oil coming down, obviously the risk increases then there. So at least we have seen varied, like from 0 to 100. So it depends. Where are you placed?
So when you talk about Saudi Arabia, the oil-rich country, what is your take on the like for an example, in terms of relationship with India and Saudi Arabia, where India is probably a huge importer of crude oil till date, but which is slowly and gradually probably the vision is to replace that along with the alternative source of energy. So how overall, like, in terms of improvement, or you can say a kind of trade deficit, how do you see that?
From India point of view or from bank credits?
From India's point of view, as well as from the banker's point of view in the long run.
So it's just my view. Okay, so what I feel is that at least what I have seen from a global banking point of view, to the limited awareness or understanding I have, is first of all, everyone knows that alternate source of fuel is going to be the reality and future, right?
Correct.
So banks,
And there
at
is
the same time,
and sorry to intervene, there is also, like, if you purchase a EV, there is 100% tax benefit on the interest part.
yes.
So actually government is pushing that. This is apart from all your tax benefit facilities which is given.
But what I have seen is at the same point of time, they know that it's going to be a slow process, right? So it's not that
It's going to be
from
slow
tomorrow
process.
itself they will stop funding any oil business and they will transition. So it's a very, very difficult situation I have seen for banks, at least, to what to do, right? Because at one point of time they want to push for this clean energy funding, which also require a lot of capital, and at this point of time they do not know how much benefit in terms of business it might bring in the future. Oil, they know, right? They, over a period of year, they'd have that experience. But at the same point of time, they cannot stop oil funding as well. So what I have seen they have done is that the kind of comfort they had with oil-rich countries earlier, that is somewhere slowly banks. Earlier, it used to be like, if it is an oil-rich country, you do not have to worry, right? That's the way they used to think of. But now banks are very cautious. It's collateralized business they do with them, because and also one more thing, right? That oil prices fluctuation is also very severe, right? It used to be not that too. Earlier, I have not seen to that extent it used to happen, but the way it is happening now, war is also some of the things. So geopolitical uncertainty is really making bankers very nervous, and credit risk is becoming more and more important, right? And right now, at least banks want collateralized business more than obviously uncollateralized business. So very high level to the extent I know.
Absolutely.
From India point of view, I think, let's see. I think it's too early, but it depends on how company form policy around it. Because what happens is, one is obviously the business sense of it. Second is also the political sense of it, right? It goes both.
Correct.
So maybe what we are discussing, it's true and maybe very valid from the environment, business point of view, but when the decisions are done, there are a lot of political angle is also involved, right? So I've always feel that let's wait. It's not an expert,
so the point is, a time was there when I had started my own you can say this solar panel installation business. So it was before COVID, then naturally COVID came. So I had been to, like you can say, kind of cold calling in MIDCs. So I have seen at that time that there was a clear-cut viability which we had prepared based on the electricity bill of the clients, where they could save a considerable and significant amount of money in the long run, but nobody was interested to invest 30 to 40 lakhs, because naturally it's not, those are MIDCs, those are factories, the power consumption is much more. But currently, I guess there are some banks who are into financing of these kind of solar panels also, and especially there are some companies who are manufacturing solar panels like Tata. They have their in-house financiers, so which will facilitate the process obviously. But still there is some resistance from the customers side. Whenever it comes to a big project, for the smaller project, like, there is tremendous interest for the retail players. So that is what even I have seen. Right. Okay. Thanks, Praveen. Thanks for your views. Thank you. Okay. Anybody else who wants to talk about inventory funding? So this is a typical process of inventory funding where the supplier and the buyer, merchant. So what happens? The supplier supplies materials or inventory to the merchant, and merchant sells it to customer. The supplier recovers money from the customers. What happens for this purchasing? Merchant needs fund, right? Where from this fund comes? This fund comes from the lender, but lender, they do not directly pay the money to the merchant, they pay the money directly to the supplier. I said for Durga, I said for EV, electronic vehicle, sorry, electric vehicle. So a lot of EV has come up. If you have seen recently in a mall, I saw Morris Garage, MG has launched two EVs. One is in SUV sector, another a very small car. It looks very funny, like it is absolutely, it's a cube shaped car. Very small. Comet. Yes, Comet, right. Comet looks very funny actually. Rather, it looks very cute. So, but for short distance within city, it's okay, fair enough. So if you purchase this kind of EV on finance, then whatever interest you pay, 100% is tax. So initially, as you know, the repayment schedule is like that. Initially, you need to pay more interest and less principal. In the initial period of time, you will have high rate of high level of interest tax benefit on the interest that you are paying. Plus, it is eco-friendly also. I don't know whether it comes under 80cc or not. I don't think it comes under 80cc or. Yes, we get tax benefit on the interest paid for EV. So otherwise, you get an interest refund if you take any vehicle in the name of your company. Any asset you take under the name of a company is definitely you get a 10% refund on your interest. But normally when it talks about EV, then obviously for whatever interest you pay, you get 100% benefit. That is even in individuals. So that's how it is. Okay. So this is the overall process of inventory funding or supply chain finance. So a typical extended payable transaction work as follows. Let's say a buyer, company ABC, purchases goods from seller XYZ. Under traditional circumstances, supplier XYZ ships the good and submits an invoice to company ABC, which approves the payment on standard credit terms of 30 days. But if supplier XYZ is in dire need of cash, it may request immediate payment at a discount from company ABC's affiliated financial institution. That means company ABC's bank. And if this is granted, that financial institution issues payment to supplier XYZ and in turn extends the payment period for company ABC for additional further 30 days for a total credit terms of 60 days rather than 30 days mandated by supply XYZ. So how it operates, I'll tell you. Basically, there is a method of calculation. I think we had discussed this earlier also. Still, I can. Okay, so we have already discussed about the working capital, right? So this is the working capital gap, right? 350. So what we said, the total debtors, inventory, cash and cash equivalent is 550. And whatever creditors and bank overdraft I have 200. So this 550 minus 200, 350 is my working capital gap, right? 350 is my working capital gap. Now, since 350 is my working capital gap, means this 350 I have to pay from my own pocket. Normally what happens, this 350 into 80% is funded by a bank. So 280 lakh, bank says, I will fund you. Fund you for how many days? Fund you for how many days? Say it could be 30, it could be 45, it could be 60, it could be 90, right? Depending on the product. So what happens in supply chain finance, something is called anchor, especially in inventory financing. Anchor, who are the anchors? Like Mahindra, say I'm talking about automotive dealers, Mahindra, Tata, Maruti, Hyundai, right? Now there is a dealer. Dealer's name is say AS Motors, right? And here there is a financer. So draw IO will be perfect to explain this. Right? So here it is anchor. So here this is anchor. Now here is the dealer, right? Now anchor could be M&M, Tata, it can be a Hyundai, anybody. And this is a portion. Now here is sitting someone called as bank or the lender or the financer, right? Now says dealer AS Motor, say dealer wants to purchase inventory from the anchor. Anchor is basically nothing but the manufacturer. What happens? They order the inventory. They order the inventory, right? Now anchor says, where is the money? Dealer says, I don't have the money right now. I can pay you later. The anchor says, no boss, I cannot give you material on credit. I need my money immediately. Then what happens? The dealer approaches the bank. In between, something else also happens. Bank has list of anchors already. So bank has already a list of anchors, including, say, it could be Maruti, could be Hyundai, could be Tata, could be Renault, like this. And there is an agreement which takes place between the bank and this dealer and these companies. Right? This agreement happens between bank and these companies that I will make payment for your dealers directly to you. And for every dealer, say there is around 100, 200, 500. So for every anchor, there are multiple dealers, right? So for example, say T1, T2, T3, like this. No, anchor is not master distributor. Anchor is the manufacturer. Anchor is the manufacturer, right? Same here. T2, T3. Same here is T1, 2, T3. Now, bank has the master. Yeah. Bank has the master for all these dealers, which comes under all these manufacturers and location wise. So for an example, if you are in Calcutta, then probably if you want to purchase a Tata Nexon, you could approach Lexus Motors. Or if you want to purchase Maruti, then probably you can approach a dealer in Mumbai. Could be like, you know, Chamunda, what do you say, that AS Automobiles or something. There are a lot of dealers, right? So what happens whenever a proposal comes from dealer to the bank, bank says, bank will send a letter to the anchor. And what happens actually for every product, like for Maruti, for Hyundai, for Tata, for Renault, an amount is already allocated, pre-approved, and it is in crores. Say for an example, 50 CR for Hyundai. Let us say for ICICI Bank has approved 50 CR for Hyundai. Now this 50 CR can be encashed by all over India, whoever dealer is there all over India. The moment 50 CR is reached, disbursement will be stopped. Up to this much is clear. It's a slightly complicated process in real life scenario. So please write in the chat box if you don't understand this. So the moment 50 CR is reached, no more funding to any Hyundai dealer will take place by this bank, right? And each dealer is having their own limit based on their criteria. Now, 50 CR limit for Hyundai doesn't mean, so yeah, so like this number for this manufacturer happens at anchor onboarding. There is something which we called as anchor onboarding. So anchor onboarding means manufacturer onboarding. When we do anchor onboarding, we onboard the manufacturer, and during that we do due diligence of the manufacturer. We analyze everything about the manufacturer, and we make a credit note which is approved by LC committee, and then we arrive at a limit which could be 50 CR for Hyundai, might be 20 CR for Renault, right? Depending on their business and a lot of factors. Now, this is the max limit for Hyundai for this bank. Now, does it assure that all the Hyundai dealers will have an inventory limit by the bank? Might not be. So it is from both the sides. So for an example, one dealer is very much okay with the terms and conditions of HDFC. So they have taken inventory funding from HDFC. They have not approached to ICICI, or similarly, ICICI is not comfortable for a dealer. Though the ICICI is tied up with Hyundai, doesn't mean that this particular dealer will be funded by ICICI. It depends on the credentials of the dealer itself, right? So it happens like this. Inventory funding happens like that. Now, the moment an indent is raised by dealer to the anchor, anchor says, you pay me money, I will give you material. The indent copy is sent to bank. Bank sends a mail to the anchor. Anchor says, yes, fair enough. You supply, you give him the money, and you give me the money. I am okay for that. Then once the bank transfer the money to the anchor, anchor supplies inventory to the dealer. And all the invoice details, everything comes to the bank. Right? Now there is a tranche of say 60 days or 30 days. After 30 days, the dealer has to make payment to the bank. This is how the entire cycle operates. Now, what about monitoring? So I think we talked about stock audit a few days back, where every bank appoints a stock auditor, where once in a quarter or sometimes once in a month, the stock audit generally happens once in a quarter. The stock auditor visits the godown of the dealer and checks whether the inventory in stock, inventory in transit, plus the debtor is equivalent to the amount of the total outstanding as on date or not. Right? So that is something which is called stock audit. Apart from that, a stock statement is taken every month by the bank from the dealer. So this is the overall monitoring process of the inventory finance. Anybody has any query till now? Before I go ahead, any query or any input for me? Okay. So what exactly I told you, the same thing is written here. Determine how much inventory you need. Price, shop, manufacturer of the wholesaler. Choose a term loan or line of credit. Normally it's a line of credit. Compare the top lenders, interest rates and terms, and have your inventory appraised if required. There is another kind of working capital facility that is factoring. It's a financial transaction and a type of debtor finance in which business sells its accounts receivable to a third party at a discount. It is to some extent equivalent to bill discounting, where that these are my debtors, I'm selling all these invoices to you, and you give me a price discounted. You give me the amount net of discounting. This is how the factoring process happens. So this is the credit issuer, this is the financer, importer and exporter. So there are two sides of factoring. One is factoring, another is reverse factoring. So what is factoring? When the supplier supplies physical goods to the buyer and the buyer, customer pays the suppliers, and the factor, the finance company, he gets the invoice copy and the finance company finance the payment to the supplier. So one is supplier takes materials from the buyer, approaches the financer with the invoices and gets it financed. This is called factoring. And what is reverse factoring? The reverse factoring is buyer approaches the financer along with the invoices, where the factor or the financer pays the supplier the money and it recovers the amount from the buyer. So this is what is called as reverse factoring. This is a typical working capital gap. Current assets minus current liabilities. You check the working capital gap. Okay, tell me one thing. What if the working capital gap is negative? What does it mean? What if the working capital is negative? What does it mean? What does it mean when the working capital is negative? Anybody? Say if current asset is more than current liability, what does it mean? Sorry, current asset is less than current liability. What does it mean? Lack of funds funds to compensate the regular or operating expenses of the company. Okay. So guys, that's all for today. Any input for me? How was the session? Any query? Okay. Any query? Okay, guys, thank you so much for attending. Let's wrap up. Have a nice weekend. We are connecting tomorrow sharp at 8. Okay, bye. Take care. Have a good day.